welcome back, my friends. As promised, we have a comprehensive example now to illustrate the rules with respect to a discontinued operation. So let's jump in and do it. So here are our facts. We got a trial balance on the next slide. We're going to have the income statement accounts for year one. Now, the name of the company is All Sports Company. Okay, that's the trial balance they're going to give us. They want to get rid of the golf division. Now, this is going to be a strategic shift in the business. It's going to affect the financial results because they're not going to have the revenues and expenses for the golf division anymore. They're not going to have the assets and liabilities for the golf division anymore. They're not going to have the cash inflow and cash outflow for the golf division. So it's a major segment, strategic shift. They want to get rid of it because it's losing money on a monthly basis. Okay, now the golf division's income statement accounts, they're going to give us in a second. We'll see that. The board of directors decides on what date? April 30th, year one. That's very important to dispose of the golf division. Stop right there. I don't care if they sell it in year one or not. Once they adopt the plan to sell it, now the discontinued operation rules apply. Okay, it's being held for sale. Now, the other thing I want to note is the date. Although they adopt the plan on April 30th, look, when we're doing the year-end financial statement, the income statement, profit or loss for that year in year one, it doesn't matter to me that the plan was adopted on April 30th. From January 1 to December 31st, all of the revenues and expenses for that entire year are going to be reported down below under the heading discontinued operation. Okay, so keep that in mind. Now, once they adopt the plan, what's the next thing are you thinking? Well, what's the difference between the carrying value versus the net realizable value? The carrying value, also known as the book value, versus the selling price minus the cost to sell. Well, let's see. The carrying value of that division on April 1st is $4 million. Yet they tell me the fair value less the cost to sell, so they did you a favor. They calculated the net realizable value for you is $2.2 million. Stop right there. You've got to calculate an impairment loss, rule of conservatism. You've now got to report this golf division at the lower of its carrying value $4 million or the net realizable value of $2.2 million. So the first thing we're going to do, write down, number one, $2.2 million, that is the net realizable value. That is lower than the carrying value of 4. So we're going to report an impairment loss before tax of $1.8 million. And where's that impairment loss going to go? Not in category number 2 with the non-operating, no. Since this is an impairment related to a division that we're selling off, that impairment loss of $1.8 million is going to be reported down below under the heading discontinued operation, and then we're going to have to multiply it by 1 minus tax, the tax rate, to get that $1.8 million before tax to after tax, but we'll do that in a second. The next thing I'm thinking is, well, when I do that income statement for December 31st, I'm thinking it doesn't matter to me that they adopted the plan on April 30th. I want all of the revenues and expenses, all the results of operations, not from just April 30th to December 31st. That's going to be a common mistake. But from January 1 to December 31st, all the results of operations for that golf division are going to be reported as either looks like a loss on operations for this golf division. Okay, so now let's see. They tell us after many months of negotiations, the assets are sold. Now, the net assets are sold on June 30th, but of what year? Year 2. That's the actual disposal date, June 30th, year 2. Now, stop. That actual gain or loss on sale is going to be reported not in year 1, but in year 2 when it actually happened. So now I would want to set myself up and do the math for that. The gain or loss on sale. It's going to be the selling price minus the carrying value at the time of sale. Now remember, in year 1, we're writing it down from $4 million to $2 million too. So the carrying value at the time of sale is going to be $2 million too. What was the selling price? Well, they tell me after months of negotiation, they were able to sell it for $2 million. This is the exam you stop. Do that calculation. Selling price of $2 million minus the carrying value at the time of sale, $2.2 million. We're going to have a loss on sale of $200,000. Now that's going to be reported when? In year 2. The loss on sale will be reported in year 2, and that's going to be reported net of tax. Now look, in year 2, not only do you have that loss on sale, but from January 1 to June 30th, you still had that business. So you're going to have to report your profit or loss on operations from January 1 to June 30th to the date of sale. And in year 2, that actual gain or loss on operations would be reported under the heading discontinued operations. Okay, now they tell me the golf division has been losing $200,000 a month. Now, it doesn't say it clearly, but that was true for both year 1 and year two, they're losing $200,000 a month. So going back to year one, we know we have that impairment loss. We want to report that division conservatively, lower of carrying value or net realizable value. We write it down from $4 million to $2.2 million. We'll have the impairment loss before tax of $1.8 million. And even though we adopted the plan on April 30th, from January 1 to December 31st, that's 12 months, we've been losing $200,000 a month. That's $2.4 million before tax. Loss on operations, okay? That will be reported under discontinued operations for year one. So year one, we're going to have the loss on operations before tax, 12 months times $200,000 a month, $2.4 million. And in year one, we're going to have the impairment loss. The impairment loss, $1.8 million. Both of those are going to have to be multiplied by 1 minus the tax rate. Now, year two, we know we have the loss on actual sale of $200,000, the loss on disposal, but we're also going to have the loss on operations. Now, from January 1 to June 30th of year two is 6 months. 6 months times the $200,000 a month. In year two, we'll have loss of operations, but only of $1.2 million before tax. And then that'll be multiplied by 1 minus the tax rate. Okay, so here are the requirements. Using the information in the trial balance, how should the disposal of the golf division be reported in year one and year two? Now, right above the requirement, I want you to note what they've given us here. They've given us the income from continuing operations for all sports company, the income from continuing operations for years one and year two. That means it excludes the golf division, because income from continuing operations obviously would exclude the golf division because that's discontinued. What I want to show you, though, because we have the available information, if they did not give you the $4,875,000 for year one, but if they simply gave you the trial balance on the next slide, how would you find that $4,875,000 if it weren't given to you? I'll show you how to do that now. Okay, so let's take a look. Trial balance, year one. You ready? Notice on the left-hand side, this is year one only. We've got all the components, the total for this company, and then we've got the golf division, that major segment to the right. First thing I would want to do is, I would want to separate for the company, and what was the name of this company? My short-term memory not so good. All Sports Company, okay? The All Sports Company there. All components, you ready? I now want to calculate that $4,875,000 for myself. What if that weren't given? So on the left side, I've got sales of $21 million for all the different segments of the company. On the right side, I see of that $21 million, how much was from the golf division? $2.5 million. So the sales that are attributed to continuing operations would be the $21 million minus that $2.5 million, revenue $18.5 now, okay, for continuing. Now, do you all see all the operating expenses, cost of goods sold, freight out, selling, commissions, advertising, insurance, salary, depreciation? All of that is part of your operating expenses. Add that all up. What's your total operating expenses for the entire All Sports Company? $16,605,000. What are the operating expenses just for the golf division? Add that up. The $1,850,000, $135,000, $220,000, $600,000, $750,000, $850,000, $495,000. What does that add up to? $4.9 million. Let's isolate the operating expenses for All Sports Company that are going to be continuing. $16,605,000 now minus the $4,009,000. That's $11,705,000. Those are the operating expenses for the divisions that are continuing. So the revenue, $18.5 continuing, minus the operating expenses for the continuing, $11,705,000, we get a subtotal. We've got operating income of $6,795,000. Now, the non-operating, the unusual or infrequent for All Sports Company, the unusual or infrequent for the All Sports Company. Let's see, they got the interest revenue, other revenue, gain on sale of assets, and interest expense. All four of those items, bracket them off, the 6,000 accounts there, as well as the interest expense, that's all non-operating. So, I go back to my setup. Revenue $18.5 million minus the operating expenses $11,705,000. Category number one, operating income for All Sports Company $6,795,000. Plus or minus their non-operating. Obviously, the gains exceed the losses, so the non-operating, that's income of $1,330,000. If you add up the $750,000, $300,000, $400,000, then back out the interest expense of $120,000, that's $1,330,000. Those four accounts netted out. Add the $1,330,000. I get continuing operations pre-tax of $8,125,000. Then I subtract out the tax expense. The tax expense is $3,250,000. Okay, the tax expense would be $3,250,000, and that would get us our continuing operations after tax of $4,875,000. Now, how did I calculate the tax expense of $3,250,000? Well, if your income from continuing operations pre-tax is $8,125,000, they gave us an income tax rate here. If you look with me, the income tax rate is 40%. Okay, the income tax rate is 40%, and I believe that was given in the original facts. So if you go back to the prior slide, just above the requirements, the income tax rate was 40%, okay? So $8,125,000 times 40% gets you tax expense of $3,250,000. That gets you income from continuing operations after tax. That's that $4,875,000, just in case they didn't give it to you. Okay, now after the income from continuing operations after tax, in year one, we're going to report our discontinued operations. Now we're going to have two items in year one. We're going to have our loss on operations for all 12 months. We're losing $200,000 a month. 12 months, that's going to be $2.4 million pre-tax. And then we have the impairment loss. They show it to you here in the trial balance of $1.8 million. That will also be reported under discontinued operations net of tax. And remember, the loss on operations is for all 12 months, even though they didn't adopt the plan until April 30th. We know the golf division was not disposed of until year two, but that's okay because it was held for sale in year one. That means in the year one financial statements on the income statement way down below, we'll have that loss on discontinued operations comprised of two items, the impairment loss as well as the loss on operations. So the impairment loss, okay, that $1.8 million, we're going to have to convert by multiplying it by 1 minus the tax rate, 1 minus 0.4, and then the loss on operations, $2.4 million, we'll also have to convert that to net of tax by multiplying it by 1 minus the tax rate. So this is what it would look like on your next slide. You ready? We've got the loss from operations, net of tax. Now take a look at this. If you go back a couple of slides with me, notice how we separately calculated for ourselves that loss on operations of 2.4. I told you on the first slide it was $200,000 a month times 12 months. But let's say it was, that wasn't given information, or I didn't give that to you. Notice the golf division sales revenue of $2.5 million minus all their operating expenses of $4.9 million. That's another way to get the $2.4 million. So either they'll tell you, hey, it's losing X number of dollars a month, or they can give you a trial balance like they've done here, where you have to then isolate from the rest of the company, hey, what are the revenues that are going to be continuing? What are the expenses that are going to be continuing? Report that separately from the golf division as in this case, but $2.4 million. Two ways of getting that number. So we've got the loss on operations. How do we get that to net of tax? 2.4 million times 1 minus the tax rate gets you to $1,440,000, and we'll have the impairment loss, the $1.8 million times 1 minus the tax rate of $1,080,000 net of tax. Alrighty, so discontinued just before net income, always reported net of tax. Okay, so specifically, how does this look? We've got our income from continuing operations after tax, $4,875,000. Now you've got your discontinued operations, two items. Loss on operations, net of tax, $1,440,000. The impairment loss, $1,080,000. Both of those net of tax. And then we summarize our results. Income from continuing operations after tax, $4,875,000 minus the $1,440,000 minus the $1,080,000. Net income of $2,355,000. Okay, so that is how it's reported and what it would look like on the income statement. Now they could easily ask you about what's going to happen in year two. So in year two, you're thinking we got two things. Number one, we didn't sell it until June 30th. So what are my results from operations from January 1 to June 30th? Well, the results on operations, for sure, year two, we don't have a trial balance. That is the $200,000 a month for 6 months. That's $1.2 million pre-tax. Then we had the loss on disposal, right? The actual selling price was only $2 million. Carrying value was written down from $4 million to $2.2 million. So $2 million minus the $2.2, we're going to have that loss on disposal. Those are the two items we would see in year two. So the year two, just like year one, got to get those pre-tax numbers after tax. So the loss from operations, net of tax, 6 months times the 200,000 loss a month is a loss of $1.2 million times 1 minus the tax rate, 720. The actual loss on disposal, net of tax, 200,000 times 1 minus the tax rate, 120. And then what would the year 2 income statement look like? You have your income from continuing operations after tax. That was given in the very first slide, 5.2 million. Okay, we didn't have a trial balance for that. That number we couldn't back into. All right, that was given 5.2 million. Now your discontinued operations. Again, loss on operations net of tax. Then you have your loss on the disposal net of tax. So you take your 5.2 million income from continuing operations, albeit after tax, minus the 720, minus the 120. Hey, year 2, your net income, 4.360. All righty. So, I mean, you'll see other examples. We want to, mix it up. Sometimes we will have a bidding war, like where we said, hey, you know what? We wrote it down from 4 million to 2.2 million. Then in the next year, there's a bidding war somehow, and then the net realizable value jumps up to some big number. Remember, you can reverse that impairment loss you recorded in the prior year, but you can't record a gain of more than that prior year's impairment loss. The carrying value can never exceed what the original carrying value or book value was. Outside of that little twist, I mean, this was a pretty good comprehensive example, all righty? So you should bang out the discontinued and certainly, if you're discontinuing going out with your friends, there's no excuse for you to not master the discontinued operations here.